I'm Andrew Bell, and I'm Scot living in London, and I thought it was interesting to have a look at some of the forecasts we made for oil revenues for Scotland in the event that independence came about, or indeed the oil revenues coming to the United Kingdom Exchequer in the event that independence doesn't go ahead. And I do that from the perspective of a former oil analyst and someone who's running a mineral company, and we're just starting to do some oil drilling in England and also in the United States. And so the first thing is to look at, as a starting point, what the revenues to the Treasury have been in 2012-13 and 2013-14. And they were £4.4 billion in 2012-13, in 2013-14 £3.6 billion, so a decline of about £800 million. And with the inclusion of petroleum revenue tax, the totals are £6,130 million, £6.13 billion, going down to £4.67 billion. So that is a decline of £1.45 billion. Now, is this something that is going to continue or not? That's the question, because what the Scottish National Party has been suggesting is that by 2018 the revenues to Scotland alone would be £5.7 billion. Now, the figures I've just been giving you are therefore the United Kingdom. Let's assume that 90% of those revenues are for the Scottish sector. It'll be something between 80 and 90%, because most of the oil is off Scottish waters, and Scotland and oil is higher value than gas. We're then talking about the total revenues the last 2 years being about £5.5 billion attributable to Scotland, going down to about £4.2 billion attributable to Scotland, and the suggestion that by 2018 it would be £5.7 billion. Now, on the face of it, you might say, well, that doesn't sound too unlikely, but in fact I think it's extremely unlikely. If we look at another table I have here from the government, this is the tax revenues. You look here, chart C2, UK oil and gas production, sterling oil price and total expenditure. Now these three series are all based on 2000 as an index of 100. So all three lines come together at the point 100 in 2000, and then you see the changes since. Now from 2000 to 2003, the oil price didn't change very much. And from 2000 to 2003, the production from British offshore waters didn't change very much. Therefore, there wasn't a big difference over that period in the tax revenues going to the British government. But from 2003 to the present, there's been a decline from that index of about 100 to something between 30 or 40. In other words, a 60–70% decline in production. And you would have thought that would result in a huge decline in revenues, but it hasn't. And the reason it hasn't is because from 2003 to the present, there has been an even more significant rise in the oil price. And that rise in the oil price, as you can see here, is from 100 to about 360. So that's a massive increase. It's masked the effects of the decline in North Sea oil production. And that decline is something that has long been forecast. It's a result of natural depletion of these fields. And the replacement production that is coming in is in more and more distant waters. For example, people are now exploring 3.5-hour helicopter ride west of the Shetlands and on the edge of the continental shelf. That's about as as extreme as you can get. And once you've done that sort of thing, there's not that much left. But it's also very high cost production. So what's happened in the last few years is that you've actually got, looking here at the corporation tax revenues, you've got them in the 1990s going down to less than £1 billion a year, 300–400 million a year. The end of the 1990s, 1.8. And then over that period from 2000 to about 2003, that I said to you was more or less static, it remained at about £2.5–3.5 billion a year from corporation tax, and total revenues at about 4.5 to 5 billion a year. But from 2003–4 onwards, it began to take off as the oil price rose, and so it went to 7, 6, 10, 5, 7, 9, 4, 3.5, and that's where we are now. So in the last 3 years, from 2011–12, despite higher oil prices, the corporation tax receipts have fallen from 8.8 to 3.5 billion already. And over that period, the petroleum revenue tax receipts have fallen from 2 billion to 1.7 to 1.1 in the latest year. That downward trend is even with not a great deal of change in production over that year or two, and with prices remaining very high. But the overwhelming probability is that prices are not going to remain at these levels. If they remained at these levels, the reduction in production would still carry on, and there would still be a decline in corporation tax revenues. Even more significantly, there would, I think, be a decline in petroleum revenue tax revenues, because against petroleum revenue tax you can offset a lot of expenditure. And if we look now at the DEC figures, moving from the revenue figures to the Department of Energy and Climate Change, you can see capital expenditure has actually had a huge recent increase. In the last 3 years it's gone from, they're actually not including the latest year for which I don't have figures, but the 3 years before that, exploration and appraisal expenditure, in other words development expenditure, went from and maintenance went from 7.4 to 10.7 to 13.3, and I'd suggest that the latest year is probably higher. In part that represents a more bullish attitude towards development because of high oil prices, but in part it also represents the fact that you are really in the expensive fields now. You're draining the bottom of the barrel. And to the extent that this high level of expenditure may be not discretionary but necessary, even if the oil price comes down, it will be sticky downwards. It won't come down very much. Therefore, it is likely that if the oil price comes down, not only will corporation tax revenues come down quite substantially, but the petroleum revenue tax revenues will really fall off a cliff.